Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, August 8th, and then we'll see how things look for Wednesday, August 9th. I have my regular computer back now. Nothing but a little WD-40 and some duct tape, and everything's good to go. Anyway, we are negative right now. We had a down day, but we hit the low earlier in the day and spent the rest of the day clawing back. Even though we continue to be negative, support continues to hold. Now, there's a few charts that I can't show today because there's some erroneous data when it comes to the volume for the S&P 500. Some of the charts look really funky and they're really useless right now, but I'll try to do the best that I can. We are still negative and going through a weak seasonal time right now. In the bigger background picture, we're still positive, but we'll just have to navigate through what's happening right now and see when do we finally get to some kind of a bottom before we turn and go back up. Yes, I do have the regular computer back now, so I'm happy about that. Hopefully things will stay this way for a while. Also, I'm thinking of putting on a free online course at some time in September. A couple of people have responded. It's like, well, what are you going to cover? Well, I already have a basic stock market course that's posted on YouTube. If there are some areas inside of that course that you'd like me to dive into a little bit deeper, I could do that. I'm kind of trying to leave it up to you. I also have a course on technical analysis where I could go deeper on that. I have some strategies in a bigger course that I do offer, and then I have a mental analysis course. Think about that and see if there are any particular areas that you would like me to hone in on. It can't be too expanded because then it would go on forever. I don't know how long the course would be. I'll have to kind of get some feedback and put some things together. Now, at the same time I'm asking you for input, I'm coming up with a list now that I have my computer fixed, and I'll start coming up with something a little bit more definite. Right now, I just want to know if there's even any interest in some kind of a course at all, and then kind of go forward from there. All right, let's go back and talk about what happened. At the open, we gapped lower. We gapped at S1, which, believe it or not, was at 4,500. I had to round that up a little bit. We also went down below S2 at 4,481, and we found support. I'm not quite sure what level that was at. It might have been in a different index. Again, some of my charts are a little messed up today. Prices spent the rest of the session then rising back, and we closed at R1, which is at about 4,500. We're just a few ticks below that. I rounded it up. We were down 0.42%, and I'm not really sure about volume. That's where the mix-up is. The technicals are negative right now. We're a little bit oversold in the short term. We're pretty much just straight negative in the intermediate term. The long term is still hanging in there being positive. It's all about inflation and interest rates. Now, we will get the CPI on Thursday. That's the biggie. We'll get another kind of big one on Friday with the PPI, so the market might be a little calm ahead of this report coming out. There are concerns that are growing about global growth. See, we had that positive scenario going for a while. Now we're shifting over to turn things into a negative scenario because China came out with some trade data and their exports are down 14.5% year over year. Their imports are down 12.4%. There's so many U.S. companies that do business with China that could cause some problems. Bank stocks were weak because Moody's came out. Fitch came out and downgraded the U.S. debt. Moody's has now come out and downgraded the credit ratings for 10 smaller U.S. banks and put some of the bigger banks on a watch list. Ooh. The perma bear that I refer to from time to time, he has predicted that the financial sector as well as the bank stocks are really going to hit some difficult times, and they got hit a bit on Tuesday. We'll have to see if that continues, but we're also seeing some charts improve in that sector, and I do have those to show you. And I've given up on saying the Fed is not having any speeches in August because they keep coming out with them even though there's none on their calendar. Philadelphia Fed President Harker, who is an FOMC voter, suggested that the Fed could be done raising rates, something that the market's already anticipating, and that they may need to hold those rates higher for longer, something that we're already dealing with, and that he doesn't see any likely circumstance for an immediate easing of the policy rate. Again, something that the market is already digesting. The S&P now sits right at about 4,500, just a little bit under that. Despite the down day, support continues to hold. That's what I'm watching right now. We can be as negative is, but until we close below support, it's really hard to take things in a more negative fashion. At least that's my stance. On a short-term basis, we have our Stochc RSI, as well as the CCI 14 and 20 and the stochastics. They are extreme negative and flashing some oversold indications. The dollar was up and interest rates were down. The dollar being up, and it was up kind of strong, that put some headwinds on stocks, where interest rates being down helped to give some tailwinds to stocks and produce more of a late-day comeback. The 30 to the 5 is back to being normal, where the rest of our yield curves remain inverted. Sentiment is still positive. We're at 70, where we had been at 72. Looking at our trend, it's still positive, but it's declining, and the green line, given another day or so, could cross below the red line, turning our trend more negative. The ADX is still showing that we're in a trending environment, even though the ADX is below its moving average. So we're seeing a weakening trend, but we're still above 20, so that suggests that we are in a trending environment. Our bias is negative with the down day, and I'm keeping our momentum at negative to mixed right now. We're negative technically, but I'm keeping it mixed as long as we still stay above support. The economic reports that came out, we had the NFIB Small Business Optimism Survey, came in a little bit lower than expected at 91.9. They thought it would come in at 92.1. Last time it was at 91. The trade balance showed a minus 65.5 billion. A little bit more than the 65.1 billion they thought. Last time it came in at minus 68.3 billion. Wholesale inventories down 0.5%. They expected it to be down 0.3%. Last time it was unchanged. None of these are real market movers. The first one is the NFIB Business Optimism Index, where it had been falling, but it's starting to show some improvement. Then we're looking at monthly nominal trade. This is just raw score, not taking any kind of inflation into account. It did decline, but it had been rising as of late. Looking at nominal exports and imports, the blue line shows exports and the yellow line shows imports. Looking at the trade deficit, where it is coming back up just a little bit, but continues to be negative overall. Then our last chart shows wholesale inventories dropping below zero and continuing to decline. I do have some IsabelNet.com blog charts, and I have a couple extra that I didn't show in yesterday's video. Here is the Simple Visor Technical Overbought Oversold Composite. We had been up around this 90 level, and we're starting to drop back down, getting a score right now of 75.41. Still positive, but declining. Looking at the second quarter, they think that that's when earnings are going to bottom, and then we're going to see some improvement after that. So this is justifying prices going higher. Please keep in mind that we're taking financials out of this calculation. Then inflows into emerging markets, they're starting to pick up. Remember way back at the beginning of 2023, it seemed like the emerging markets were all the craze, and then that just kind of went away. Well, we're seeing some money starting to go back into those other markets now. This is the same chart, but it looks a little different than the relative rotation graph that I usually show in the weekly video. Where think of this back to your geometry class when you're studying x-axes and y-axes, where the orange line going across, that's the x-axis. The blue line going up and down is the y-axis, where we have plus in the top right. And then we go negative with the x, so it's minus plus for the improving. If we drop down to the lower right-hand corner, that would be plus minus, because the x is plus, the minus is y. And then in the lower left-hand corner, it's minus minus. And we have been seeing some areas that are showing a little bit of weakness now, but discretionary and tech continue to be leading, and that's what we're seeing in our charts. Communication had been doing well, but is starting to show some more weakness. Some other areas like financials, industrials, and materials are showing some improvement after really lagging behind, and some of the more defensive/value areas are the ones that are lagging with a minus score. Are you likely to increase or decrease your stock exposure over the coming days and weeks? 36% say they're going to add to their positions. The equity allocation, we're still at 61%, where it has been coming up, and we're above the average level here as a percent of their assets under management. The exposure to bonds starting to come down as bonds have been running into a little bit of trouble. The calendarized flow from global investors in developed markets, which is the US and Western Europe mostly, and emerging markets, which are a lot of the Asian markets and South American markets and so forth, we're seeing that it's just about slightly positive so far in 2023 when we compare it to other years. The effective funds rate minus the core PCE, we had that report a little over a week ago. It is showing that the Fed funds are going up as inflation has been coming down. And we're wondering, when we look at this score, we're under 2% right now. The Fed wants to get to 2%. Now, they probably want to get to a real CPI number of 2%, but this could suggest maybe they're getting close to being done raising rates. Then the quarterly year-over-year earnings per growth relative to the consensus. Going into where we're at right now, we're down 6%, where the consensus is that we're probably going to be down 9% on a year-over-year basis. So we have been seeing a real trailing off in the earnings per share, but the forecasts are suggesting that things are going to hit bottom and start to go back up. The core PCE and CPI, the gray dashed line is the core CPI. We're going to get that in Thursday's session. The core PCE we had a little over a week ago, and it shows both of them continuing to decline as far as inflation. And then U.S. public debt to rise by $5.2 billion every day over the next 10 years, where it's just showing that public debt is just going to continue to go up and up and up into the future. Let's get into our charts and analysis, where we gapped below S1, we also gapped below S2, and then we came down and set a support level here. Again, I'm not really sure why this level was chosen. We exceeded any of the previous recent lows, but then from there we started to come back up and then close at about S1. The intraday chart, we were flat in the initial overnight session. Then when Europe opened in the pre-market session, that's when we saw a lot of weakness. We saw some follow-through weakness in the cash market, and then the recovery coming into the latter part of the day. We're pretty much flat in the initial overnight session for Wednesday. We kind of see a similar pattern here when we look at growth and value. Value outperformed growth since the red line is on top, but after we hit bottom, we saw a recovery in both of those areas. So on a closing basis, everything was down, but growth was down a little bit less with the large caps, down a little bit less with the mid caps, and down more with the small caps. Our intraday growth value ratio, and this is what I'm watching more and more as the day's going on, where this is actually a little bit positive, and this helped give some of the recovery that we saw later in the day, because as the market was tanking lower, growth was shooting up higher. As the market was recovering, we saw the growth to value ratio going down. That could mean that there's some smart money coming in and buying growth stocks on weakness. Looking at sentiment, showing a little bit more fear with our Ulcer Index. We ticked up a bit with the line chart of the VIX, also with the bar chart, even though we closed near the low of the bar. The volatility of the VIX is picking back up a little bit with the line chart as well as the bar chart, but it did come down from reading higher levels intraday. Keeping an eye on the VIX to S&P 500 correlation. After spiking up and coming down, we've been going back up slightly. We're really focused on this previous spike to see if that's going to have an influence on the market. Again, as I point out every time, sometimes this marked a top, sometimes it marked a bottom, sometimes it just meant a continuation. The SKU index, after spiking up into the red area, is now starting to come back down. Is this going to be a continuation? Is this going to help support the market? Or is this going to provide some more negativity for the market? We don't really know quite yet. Then the equity put call ratio based on 5 periods. Notice how we bottomed out, but the S&P kept going higher a little after that. It seems like now we're having the hangover drop as the 5 period moving average of the equity put call ratio continues to climb. This is a longer-term look at that same chart. The longer-term equity put call ratio continues to decline. That's further in the background and is positive. Looking at our fear gauge, where it ticked down just a little bit on this chart, the other chart, it's continuing to turn up just slightly. Our ratio between risk on and risk off ticked up just a little bit, but it's still continuing to advance overall after getting hit over the last few sessions. Our advanced decline line studies saw a little bit of a decline based on price and volume, but these are still hanging in there fairly well. We're seeing the 5 period turning down with the new highs, new lows. The 10 period has already been declining. We're seeing some new highs being generated, but we're seeing a little bit more of the new lows being generated as well. Looking at the advanced decline ratio, we declined. The blue line is just barely above 0, where the red line is still above 0. Looking at the cumulative NYSE advanced decline line, where we're dropping below this moving average, but I drew another trend line in here. We're going to see if this level can hold as support. Also some different trend lines here where we broke out from previous highs. Now we're just wondering if we start to fall, will this trend line hang in there? Saying pretty much that same thing. This is a bigger picture of that same trend line. The common stock, based on price, after coming up and hitting a high, has been falling back. We did not see a breakout based on volume, as we're seeing a little bit more weakness. And that's showing up as a longer-term negative divergence when we made a higher low based on price, but a lower low based on volume. The advanced decline line studies did tick down a little bit, but all of the indexes are still above their moving averages. Our trend shows that the ADX is below the moving average. The red line and the green line, they're kissing each other right now. And on our short-term ADX, where the red line is starting to cross above as the ADX is declining. So we might be getting ready for a shift according to this chart. I don't have a volume chart to show you because that was one of the ones that were messed up. And here, you can see this huge spike. It's like we had 2 quadrillion shares traded in Tuesday's session, which has totally ruined any of the indicators that are based on volume. We're still below this pivot level, but the fact that we hit a low early in the day and spent the rest of the day coming back can be seen as positive. We're still below the 20-period moving averages, both the exponential and the simple, even though if you see this bar, notice how we closed right near the high. The 20-period exponential moving average ticking down, as is the 50 and the 200. The Stochc RSI, another crazy chart here, where we're starting to get extreme negative. The Williams percent R is not extreme negative, even though it did decline. The CCI 14 is still extreme, where the CCI 20 is now starting to get extreme negative. The stochastics, after bouncing up a little bit, are not extreme in the short term. We're turning back up in the intermediate term and just barely extreme, where we're declining with the longer term stochastics. Intermediate term charts, the balance of power, we're still below the dashed line. That's negative. The go-no-go system is still hanging in there positive. Now be aware, once we get some more data, these bars can redraw and have a different look really soon. We're still hanging out near the lowest low value, where we're seeing this red line starting to roll over as the highest high value is starting to go sideways, and we are below the midpoint. The TTM squeeze continues to show more weakness, and another day or so and we might actually drop negative. You can see this red line right here. That's based on the crazy volume data. We're coming down a little bit below the midpoint on our standard deviations chart, but again, this bar looks fairly healthy for right now. We're seeing if the 50-period moving averages will provide the next line of support if we continue to fall. Looking at our moving average tree, we're below the 20s now, but still above the 50s. We're still underneath this mini rainbow when we look at the 20-period simple moving average of the open, high, low, and close. We're wondering if we start to go back up, will one of these levels provide resistance now? The S&P McClellan oscillator, after almost getting extreme negative, did bounce up after Monday, now is more negative after Tuesday. So our summation index based on price is now declining, as well as volume. We did get a little heads up with the volume where it turned negative before price did. The NYSE McClellan oscillator also negative because it's below zero and declining. So our summation index for the NYSE is declining based on price and volume. The Swenlin trading oscillator, pretty much flat with price, did show a decline based on volume, but both are below zero. The PMO is negative, and we got a little bit of a heads up based on price and volume on this chart. So our study shows that the PMOs that are rising continues to decline. We're seeing the buy signals declining, as well as the percent of PMOs that are above zero continues to decline. The Elder Impulse system for the S&P remains negative. The parabolic SAR is negative. The slope oscillator is negative, and the MACD is negative. So looking at all of our oscillators, it probably is easy to see here where we're turned down on all different time frames. The BPI is now crossed below 70, so that's turning more negative. The NYSE bullish percent index is also declining, but still above 50. The ultimate oscillator below 50 and declining slightly, that's negative. The RSI is continuing to show weakness both with the 14 period and the 9 period. With the 9 period, we're below 50. We're just a little bit above 50 with the 14 period. Here's another change where in the vortex indicator, the red line is now crossed above the green line. We're seeing a little bit more weakness with the 200 period simple moving average and a little bit faster weakness with the 50 period simple moving average study. Our line studies here, we're still below this shorter term trend line. If we continue to fall, we'll be wondering if this other trend line may provide support. That's at about 44.50. Also, I added, when is this cycle going to end? That will be on October 11th. We came up, started a new cycle on August 1st. That's about the time we started to run into trouble, and so far we have been declining. Then we'll have to see, is this going to continue throughout the rest of the cycle, or are we going to see some kind of a change mid-cycle? Our charts are looking more negative with the hike in ASHI, and you can see the crazy volume. Also the crazy volume, the KG chart is negative. The Renko is now turning back more negative with a red box, and the 3-line break is also negative. Our different indexes showing declines in the S&P and equal weight S&P, and they're performing about the same, so we're not really seeing much of a change in the ratio. The Dow showed some weakness but still has been breaking out. Transports also down but have been breaking out. Utilities have been weak but bounced up slightly. Our transports to S&P 500 ratio did decline a little bit but continues to advance overall. That's longer term positive if that continues. And the relationship between the S&P and the transports is starting to get stronger. Our Dow to transports ratio continues to decline, even though it ticked up slightly in Tuesday's session. Our discretionary to staples equal weight study, we actually showed a little improvement in this overall ratio, and that is more positive for the growth areas, since discretionary is more of a growth area where staples is more of a value area. The Dow is still hanging out above this pivot level, so support is holding for the Dow. The diamonds have switched back to neutral. The Nasdaq also came down to this S1 level and then closed up off of that near its 50-period moving average. So this support continues to hold for the Nasdaq. We're also seeing that with the 61.8% retracement. Yeah, we fell below it, but we closed right on it. But when you look internally, we're still seeing weakness when we look at the new highs minus the lows on a cumulative basis. Also, support for the NASDAQ 100 continues to hold. We fell down, came to this S1 level, down to the 50-period moving average, came right back up and closed at this support level. But the Qs have now switched over to being negative for the Elders Impulse system. On a trend basis, the NASDAQ 100 continues to be negative. The NASDAQ 100 BPI is also negative, but hasn't quite crossed below 50. The first level is 70, and that's when we generate an overbought condition. When we go from positive to negative is when we drop below 50. The Qs to Dow ratio is showing a bit of a decline, but if you see at the bottom, their relationship is strong, so they're having a tendency to go in the same direction. I don't have the other small cap chart because it's all messed up, but we're looking more negative here with the Russell 2000 small caps. We've dropped below 50 with the RSI. We lost this resistance level and have been going down since then, and the MACD is also negative. However, in the background, we have generated a recent golden cross. The small caps for the Elder Impulse system also closed near their high for the day, but still remain negative. Small cap growth versus value, and this is what a lot of the other charts look like. I just wanted to show you this ratio where small cap growth is really starting to go down when compared to small cap value. The mid caps also closed just above this pivot level. Support continues to hold. Also for the Elder Impulse system, we have switched to negative for the mid caps. And we're seeing some more weakness here when we compare mid cap growth to mid cap value. We're still in a longer term uptrend. The FANG index came down to its 50-period moving average and was able to bounce up off of that. We're also keeping an eye on this longer-term chart of the FANG index. After we set an all-time high, fell back down, we've been chopping more or less sideways. The dollar was up strong, almost 0.5%, and that could have put some pressure on stocks. When we look at the S&P and compare it with 3 to 7 year bonds, this ratio is coming down a little bit, but we're still hanging in there, although we have dropped below the blue line. If this continues to go up, the market is predicting that we will have a soft landing. We look at home construction. It's still hanging in there. Ticked down just barely, but it's below all of its rainbow moving averages. Growth versus value is showing some weakness, where value versus growth is showing a little bit of strength. Keeping an eye on the banks, where we did close back above the 200-day moving average. Interesting. The financial sector is generating a golden cross. The financials did tick down a little bit and are in a longer-term downtrend when compared to the S&P, and the regional banking ETF ticked down just a little bit when compared to the financial sector and is also in a longer-term downtrend. Looking at bonds, where we saw a real drop in yields and a real rise in price, but we're still below the 200-day moving average. We're also coming off of a recent death cross. The RSI is still below 50, although it's going up. The MACD is still negative, even though it's turning up. We're also keeping an eye on this. We want to see this ratio going down. If we had more certainty about interest rates, it still continues to go up, even though it declined a bit on Tuesday. We're looking at the 30 to the 5-year spread where we've gone back to being normal. We're going to wonder if that will last. We're also above the 2007 level with the 3-month yield, and we're continuing to climb. Our long-term charts. Here's the daily special K chart, still above the moving average, although it's rolling over slightly. The weekly chart of the S&P, now we're just a little bit underneath this resistance level. The NASDAQ 100 also just a little bit beneath this resistance level. The ratio, this is longer term, potentially negative, where we came up and gave a high reading. If this really starts to fall, that could be negative for the market. Also, I've been constantly referring to this, and I just wanted to show this weekly chart of the pivot points. This was the high that we set, and we've been coming back down since that time. An update of our possible positive scenarios. The Qs are underperforming the S&P. They're dropping below the moving average. Discretionary still hanging in there a bit. It's above its moving average, where large cap growth is underperforming large cap value. With our growth to value ratios, underperforming at the large caps, mid caps, and small caps. We're also watching this. This is the 19-day exponential moving average of the advanced decline ratio. We dropped below zero based on price and volume. This is also potentially positive. The S&P to utilities ratio continues to go up. The 10-day average of the S&P highs minus the lows, now we're dropping below this level. We're going to see if this continues to fall. We're also dropping below zero with our broad range of the 5-period moving average of the highs minus the lows. That had been hanging in there. Now it's starting to show some weakness. Our 50-period exponential moving average of the new highs minus the new lows is starting to roll over, but it's still above zero. Our indicators dropping below the moving average, which is causing the red line to turn down. S&P growth versus value is also showing some weakness. Shorter term in a downtrend, longer term still in an uptrend. The Staples S&P 500 ratio did decline. It's been chopping around a little bit, but it has been declining overall, and that could give support to the S&P. And then looking at what Tom Bowley posted for the month of August, it's the third worst calendar month where energy is not hot, tech tends to be hot. We're past the first part of the month, which tends to be positive. Now we're getting more into the negative part of the month. Now this kind of contradicts some of the other statistics that we look at. Then coming up later in the month, his research suggests that we see a bounce and then some weakness going into the latter part of August. He's also saying that in the month of August is when growth really starts to outperform value, but we're seeing the exact opposite right now. So our outlook for Tuesday, earnings reports. Most of the companies will report by the time we get to the end of the week. I've taken out that part about the Fed not giving any speeches because every time I say that, they go and give another speech. The technicals are negative and we're still somewhat oversold in the short term, but the big thing that I'm seeing right now is that support continues to hold. The economic report's coming out. We'll just get the MBA Mortgage Applications Index. Still keeping an eye on all the geopolitical things that are happening. Don't be surprised if Wednesday is kind of a slow session with CPI coming out on Thursday because the markets are so fixated on inflation and interest rates. Here's the updated economic calendar for the week. Looking at the Stock Traders Almanac statistics, we are neutral to negative across the board with all of the 3 indexes that we follow. We're also wondering, are we finally going to bottom out in this seasonal weakness before we see a little bit of strength going into the latter part of August? We will be on the 7th trading day of the month, where when we look at the dashed lines, we see flat to declining during pre-election years, where we tend to see more weakness when we're looking at the solid lines. Going back to 1950, we are 50-50 with our pre-election year status for the S&P. So our scenarios, we're definitely going more with the down one right now. The technicals are negative, but it's hard to really go negative unless we close below support, not only on the S&P, but all the other indexes that seem to have support holding. Not going with the up one now, our charts just don't suggest that, and we're not going with the sideways trend because the ADX, even though it's weakening, is still above 40. That suggests that there is a trending environment. So, warning signs. This is what we're kind of seeing played out. The convergence of these short-term bearish signals, we're wondering if that's going to continue. It's already caused some problems for the markets. The longer-term trend signals may be signaling a top. Now we're just a little bit below those signals. The seasonal and historical times that we're in right now are a little bit weaker. The oscillators for the S&P are negative, as well as the NASDAQ 100. The VIX is climbing when we have down days, but it's still giving us a low reading overall. The cumulative new highs, new lows for the NASDAQ are showing weakness. The 3-month yield is above where it was back in 2007 and continuing to go up. S&P growth is weakening, but it's still in an uptrend. Shorter term, it's actually in a downtrend. The weekly pivot, and I showed you that chart this time, it acted as overhead resistance about 2 weeks ago. That was when we topped out, and we've been falling since that time. The parabolic SAR is negative. The vortex is now turned negative. And then we're dealing with earnings as they're being released. On the positive side, the seasonality and setups are still further in the background. The special K daily chart is positive. The weekly chart is negative. The equity put call ratio is still positive. The S&P is still above the downtrend channel upper line. We're still in a risk on posture, even though that ratio hasn't been moving all that much lately. Lower price levels so far are providing support. Is that going to continue? The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're above overhead resistance. So we're seeing the longer we stay above that, if we're coming down, is this going to continue to provide support? But they're still below the daily pivot resistance, and they haven't been able to break through that. Also, longer-term support continues to hold. The staples to S&P 500 ratio is declining. The Russell and the small caps, as well as the mid caps, are working off of recent golden crosses. Small and mid cap growth continues to be positive. We're seeing weakness in the small caps. We're seeing a little bit more weakness in the mid caps. The financial sector has generated a golden cross. So our conclusion, we're negative, but so far support is holding. In the short term, we're negative, but we're slightly oversold. Intermediate term, we're just plain vanilla negative. My personal take on this is it's going to come down to support holding or not holding. Long term, we're still positive. If we do drop below support, it might throw our longer term trend into question. Thank you. Hope you found this helpful. Have a really good day, and I will talk to you in the next video.